Hey everybody, it's Dr. Joe. I'm back. I'm back in the USA, and welcome back. And I had a great time. I was in London for a couple of weeks, and I had a really nice time in London. The weather was pretty good, which is just unusual for England, and it was great just to see friends, family, relax. I just I took my daughter, so we had some father-daughter. Sort of events and just sort of just taking around to meet with family and just spend time with family. I had a wedding to go to, which went really, really well. Naming ceremony and a whole bunch of different things. Went to the pub, had fish and chips. Went to the O2 Center, Stratford, and it was all good. So hopefully, God willing, I'll be going back again. So that's the third country. I think a third country this year. I think it's the fourth. I forgot now. Anyway, so we're off to Toronto next week. So going off to Toronto in Canada and next Wednesday, I think, and so on. So that's the next stop. They have this thing called Caravana. It's like a Caribbean carnival. So we're going to go down there. We'll be in Toronto for a week. And so it's all good. Anyway, so today we are going to talk about interest rates. It's kind of timely. The Fed increased the interest rates by a quarter point today. So obviously that's going to have an impact eventually on mortgages and things like that. So since we've had 11, I think it's 11 adjustments by the Fed in the last year or so. So as we all know, interest rates have gone from 3% now to 6, 7, 8%. 6, 7% now. So it's kind of scary, but historically though, it's not bad. I recall when I first started, interest rates around 10%. So 6, 7% is not really that bad historically. But if all you're used to of 3, 4%, then 6, 7% is like horrendous and horrifying. Anyway, so we're going to talk about that, the effects of interest rates on real estate investors, and how that should affect your strategy, and it should. And what should you do, and how to prepare for it, and how to sort of operate in this new environment. So that's what we're going to talk about today. And as usual, we'll be having our Q&A session. And so if you've got questions, please put them together in the chat box, and I will try to get to them towards the end of today's session. So if you've got questions, please put them in the chat box, and we'll get to it. So going back to the title again, real estate has been, obviously we all know real estate is a good vehicle for building wealth, tax benefits, appreciation, leverage, and so on. And also for diversification. I don't think it's a great idea to be totally dependent on your job. I think it's always good to have a plan B. And for a lot of people, real estate can be that plan B. So, but the bottom line, though, is that real estate is affected by the economic environment that we're in. And, especially interest rates, it can significantly impact the performance of your real estate investments. So, rising interest rates, which is what we've been experiencing for the last, year or so, has been a force. It generally, as interest rates go higher, there are several things that occur. This market is a little different this time round compared to the other 4 or 5 cycles I've been through. The market's kind of weird, and I'll talk about that a bit later on. So certain things that typically occur in a slowdown or as the interest rates go up aren't really happening this time round, primarily because I think it's because there's just not a whole lot of inventory out there. But again, I'll be talking about that. So what we're going to talk about is, explore the impact of rising interest rates on your real estate investments, and also the strategy that you're going to pursue, and how to navigate these challenging times. So hopefully you'll be able to, maintain your success and things like that. Okay, that's what we're going to talk about today. And so let's talk about, first of all, the relationship between interest rates and real estate. There is a relationship, as we all know. So, so what are those? We're going to talk about the interest rate connection, also, how it sort of manifests itself. The bottom line, though, is that it plays a vital role, because interest rates have a direct correlation with the cost of borrowing money. As the interest rates go up, then we all know the cost of borrowing money also goes up. Okay. And, as the cost of money goes up, your mortgages goes up, which means that your monthly payments go up, which means that it's more expensive to operate your business. And if there isn't an increase in rents, then, which is not always the case. So your costs are going up, but your income hasn't changed, or and so on. Or if the market slows down, your income may even go down because you may have to reduce rents in order to entice and attract people. Okay, so your expenses are going up, your income is not going up at all, and so what it means is that your cash flow is going to take a hit, and that's essentially what's going on for a lot of people. Cash flows down because of the cost of money. I recall when I look for deals today, I do the numbers, do the calculations, and hey, I mean, if you're borrowing the same amount of money, 3, 4, 5, 600,000, and the interest rate goes from 3, 4, 5, 6, 7%. This is significant, increase in your costs, and therefore deals that may have worked a few months ago don't work today. And deals where you could have got cash flow a few months ago, you can't get cash flow today. So what do? Do you buy it anyway, and hopefully later on you take advantage of low interest rates if they do come down, and then refinance later on? That's an option. Or do you sit on the sidelines and wait until things get better? But things aren't getting any worse. The competition is still fierce for these limited deals because the inventory is so low. So cost is going up. Generally you're supposed to get reduced demand, but I'm not seeing that in terms of people are still looking to buy. Typically in a as interest rates go up, they are, turnover times, can be impacted, i.e. days on market to sell your house typically would go up as the real estate market goes down. So as the real estate market gets less attractive or slows down, then stuff just doesn't sell so much. Okay. So which means that your holding cost, your days on market, all those kind of things increase, which means that the costs, especially if you pursue a short-term strategy like flipping, is going to take a hit. And if your costs are going up and the market is slowing down, what happens? People tend to reduce prices, and sometimes there's a race towards lower prices. So we haven't really seen that this time round. Again, because of the fact that there's just not a whole lot of houses out there for sale, because a lot of people are kind of enticed with these low interest rate loans that they have. So they don't want to give it up. So they rather just stay in their home, keep their 3, 4, 5% mortgage, rather than sell it and have to get a new loan for 6, 7, 8%. Okay, so again, this is what typically would happen, but we're not really seeing that. That's why it's a very strange and unusual market that we're in. So let's talk about the effects of real estate affordability and demand. Typically, again, based on my experience having gone through cycles 4 or 5 times, as interest rates rises, obviously the affordability decreases, because the cost is going up, which means that you can borrow less money. So for the same priced house, okay, let's say a $300,000 house, at an interest rate of 3%, your monthly mortgage will be one number. I don't have a calculator in front of me. If the rate goes to 4%, then the loan payments go higher, and so on and so on. So which means that fewer people can qualify because your income hasn't changed. So your ability to get approved for a higher mortgage goes down. So the affordability of real estate tends to is reduced when interest rates go down, and because of that, the demand also goes down. Hopefully, this is not an economics class, but I'm just trying to put kind of connect the two together. So let me know if this is making sense, if I'm going too deep, but I want to talk about the effects of affordability and demand as interest rates go up. So as it's going up, like what's going on, affordability is becoming more of a challenge for a lot of home buyers, and therefore they won't be able to qualify for new financing, which means that they have to keep on renting. Okay, so affordability goes down, and demand therefore goes down as well. So reduced demand means that if you're selling, it's going to take a longer time to sell your house, and also because your cost has gone up. If you're renting, then your cash flow will take a hit as well. Okay, your profitability will also take a hit as well. Hopefully that makes sense, and so on. So let's talk about cash flow then. What's the effects of increased interest rates on cash flow? So we all know cash flow is the lifeblood of real estate investing. We're doing this obviously for various reasons: tax benefits, appreciation, but for a lot of people, we're doing it for cash flow, and which is your income minus all your expenses associated with that. So if you're relying on cash flow, then as interest rates go by, it's going to have a real big impact. As I said before, there are deals that I'm not even interested anymore because it just doesn't make sense at these current interest rate levels, where it could have made sense, a few months or a year ago. Okay, so high mortgage rates leads to increased monthly mortgage payments, which is going to eat into your rental income and also will reduce your cash flow. It's crucial that what that means is that it's really, really, really important for you as a real estate investor, before you go buy a deal, you make sure that you do your necessary due diligence to make sure that it makes sense. If you're flipping and interest rates are going higher and demand is going down, then you may not be able to get your price that you thought you were going to get. And so you have to be a lot more conservative on the acquisition. You have to be a lot more conservative on the expenses, like your rehabs, because otherwise you may not make as much profit as you thought you're going to make, or you may end up with making no profit at all. Okay, so it's really important to do your due diligence and really do the calculations, and to make sure that the cash flows that you're expecting are in fact real, and also make sure that you can meet the benchmarks, the profitability goals that you have, and such that it makes sense to continue in investing. Okay, so let's talk about the next thing is the effects of rising interest rates on property appreciation. So obviously, if the market slows down, then there are fewer people buying, and typically, as the market slows down, then prices don't increase as much. Again, this is a kind of weird market we're in because it's kind of unusual. But generally, as interest rates go up, the appreciation slows down, and so for those people who are banking, quote unquote, on appreciation, that may not always be a good bet in the short term. Now, in the long term, probably you'll be okay. But in the short term, as interest rates go higher, then appreciation tends to reduce. So for those people who like these short-term strategies like flipping, that's where you're going to have a problem, especially if you overrun on your expenses, whether it be in terms of the acquisition cost, the financing cost, the renovation cost, and the selling cost. If they get higher, then it's going to eat into your profits, and because the market is not going to bail you out. You can't bank on increased prices to be your savior, as you can to a certain extent when the market is hot. Okay, so it's as interest rates go up, it cools the market generally, and which will obviously have an effect on property appreciation. So be careful and about relying on appreciation, because you may not be able to as the market slows down. You just need to be a lot more conservative as we go on. Okay, so that's another impact. The next one is going to be navigating the as interest rates go up, how does that affect those people who want to refinance? Okay, so if you didn't refinance during historically low interest rates a year or so ago, well, I won't say it's too late, but it's better to refinance at 3 or 4% than it is at 6 or 7%. And so what it means is that you're probably not going to refinance into a lower rate anytime soon. So, which means that you're not going to refinance unless you really have to, unless it makes sense to. Now, obviously, if you've got a lot of equity in the home, then you want to tap into that equity. So it does make sense to refinance if necessary, because it's going to get you some extra cash, which you can then do other things with. So so as the interest rates go up, the borrowing cost increases, and which is going to impact your ability or even your willingness to refinance. Now, you could do a short-term strategy whereby you refinance today and tap into the equity, and then maybe later on another time when interest rates go down, you can refinance again into a lower interest rate. So hopefully this is good. Again, we're going to go to the Q&A session very shortly. So if you've got some questions you want to throw at me, please put your questions in the comment box or the chat box, and I'll get back to you. Well, not get back to you, but we'll be starting that in a few minutes from now. So let's just kind of talk about, summarize where we are so far in terms of the impacts of real estate and interest rate. So we talked about the relationship between the two. We talked about the effects of increased interest rates on affordability and also on demand. We talked about the increase in interest rates and how it impacts cash flow. We also talked about increase in interest rates and how it impacts on appreciation. And then finally, we talked about interest rates and how it may affect your ability to refinance. So finally, I'll do a couple more. The psychological, I think it's good to talk about some of the psychological impacts that higher interest rates will have in terms of just the market sentiment and market confidence. Okay, so as interest rates go up, it's going to affect economic activity. Generally, it slows it down. The Fed increases to slow economic activity goes down, and that's what that's what's happened, to a certain extent. But the market is still, there's still a lot of economic activity apparently. So maybe we haven't reached the end of these interest rate hikes. They're talking about maybe another 0.25% the next time the Fed meets again. So as you can see, interest rates have a real big major impact on people's confidence and consumer sentiment, in the marketplace. So as interest rates increases, there's more uncertainty, there's more apprehension, okay, and which leads to more people doing a wait and see. Let's just see how this shakes out. Therefore, I'm just going to be on the sidelines until things kind of stabilize. that makes a lot of sense. But also, it does for those people who have access to cash. Those people who are able to execute, there's less competition. So you may be able to negotiate a little bit tougher than you would be if there was a lot of market confidence and consumers were very happy about how things are. So understanding the psychology, of participants in the real estate game, whether we buyers, sellers, and so on, it does have an impact, and you can use that in your favor, or you can decide it's just too much uncertainty. I'm just not. I'm just not going to do anything. I'm just waiting until things kind of stabilize, and then I'll jump back in again. And adapting your strategy. So how do we adapt? So that's all well and good, Dr. Joe, but what does that mean for me? How do I operate in this new environment? How do I become successful in this new environment? So to really to navigate the impacts of rising interest rates, what it means is that you have to have the right strategy, or you have to adapt your strategy based on the realities that we're in. So if you're a fix and flip person, then if that's what you do, if that's your niche, that's okay. It's just that you now have to be a lot more conservative, because there's no guarantee that you can sell at at the price that you thought you would sell it for. They may not get the appreciation. Your costs will go up because the cost of goods have also gone up as well, and the cost of money has gone up. So it just means that in order to survive as a fix and flip type investor, you just have to be a lot more conservative. You have to make sure that you do your due diligence thoroughly, and you make you incorporate a lot of the what's the right word? You incorporate assumptions, and and contingencies into your calculations. What if scenario? What if this happened? How am I going to be able to operate? Or is there money to be made if prices go up, or they stabilize, or they go down? Okay, so what your due diligence becomes very, very important. And if you're in the short term, sort of fix and flip environment, if you're in the buy and hold environment, you're essentially taking a long term view of all this. And so for me, I'm a long term investor, as you know. I take a long term view. Yeah, we're going through some little tough times. Yeah, interest rates are going up a little bit more, but over the long haul, appreciation is taking a hit, but over the long haul, there's a pretty good chance that the property prices will appreciate. And therefore, since I've taken a long-term view, I need to just be able to survive these turbulent times that we're in. And which means that I have to make sure that my cash flow is maintained. I have to make sure that my tenants are happy so they don't leave me, and I have turnovers. I have to make sure that I spend more time on customer service, because good tenants are hard to find. Everybody wants them, and you can be sure that your competition, your other landlords, are going to be also trying to poach the good tenants from you as well. Okay, so if you're a buy and hold kind of person, this is where the systems come in. This is where your customer service skills come in. This is where your ability to attract quality tenants and keep them becomes really, really, really important. Okay, so if you're a fix and flipper, that's what that will do. And the other thing is to maybe diversify, to mitigate your risk. You may want to diversify geographically. You may want to diversify in terms of the price point of the properties. You may want to diversify by maybe your asset class. So if you're a single family person, you may want to do multifamily, or vice versa. But the idea is to reduce your exposure, and you diversify in such a way that if things aren't working out in one area, you've still got positive activity in another area as well. Okay, so the idea is to minimize your exposure by because of interest rates reductions or increases or fluctuations. I'm sorry. The way you do that is to create a more well-balanced portfolio. Okay, so what are some of the strategies for long-term success? I'm kind of wrapping it up now. I think that the chances of long-term success is you take a long-term view. And because the long-term view, and you have the right relationships in place, systems in place, people in place, team in place, then you can withstand these short-term, turbulent waters that we're in, and you can sort of, insulate your portfolio against the effects of rising interest rates. So, what do I mean? I mean things like be conservative in your debt to income ratio. Don't buy the max that you can get in terms of the loan. Okay, be conservative. Instead of going all out 80, 90%, maybe go 65, 70%. Leverage more into fixed rate loans, fixed rate mortgages, as opposed to variable mortgages. That's something you can do for long term success in these turbulent markets. And as I said before, you can conduct thorough market research and due diligence before before you decide to execute and purchase a particular home. And that's something that you can do in terms of a strategy as you move forward. So, in conclusion, interest rates, they are what they are. That we are in an increase in interest rate environment. I don't think that's going to change too much in the next few months. So we're just going to have to just deal with it. And but you need to understand the impacts that interest rates can have in terms of what you're doing, in terms of your profitability, in terms of your business strategy, and so forth. So what it means is that investors like you and I, we need to be proactive. We need to be well informed. We can't bury our head in the sand and pretend it's going to go away. We need to prepare to adapt our strategy, as the economic environment changes. So understanding essentially understanding the relationship between interest rates and real estate is going to allow us to be proactive, to be able to adjust our strategy, and stay on top of the ball. These are crucial things. Evaluating cash flow, understanding market sentiment, monitoring interest rate fluctuations. These are critical, allowing you to weather the storm as we kind of pursue or enter this, this stage that we're in. So by embracing diversification, it's also another good strategy. You can build resilience in your portfolio, and you can possibly thrive as others kind of clamp down and close up. So remember, preparedness is the key to success in any market environment, and you can be successful. You can navigate these challenging times that we're in this rising interest rate environment. And as a savvy real estate investor, you can position yourself for long-term success and be able to survive as we go through these turbulent times. I've done it. I've been doing this for about 35 years now. I've gone through 5 real estate cycles. There are ways, and I think we can do this. And it's scary. There's a lot of unknowns, but we're good. And hopefully that was helpful. So with that said and done, my friends, that is it for today in terms of the education part. I'm going to go down to the Q&A, Ask Dr. Joe segment. And so if you got some questions you want to pose to me, please put them in the chat box and I will answer them shortly. And if you got to shoot me an email, I can reach the Joe at joeasamoah.com. Joe at joeasamoah.com. As I said earlier on today, at this live stream, I'll be going to Canada, Toronto next week. I'll be gone for another week, another vacation to country number 4 and this year. So my goal is to do 4. Well, my goal is to do 3. So this would be number 4. I think I'll probably do another overseas trip in 2023 as well. So that's something I've been striving for, and I love traveling, especially to different countries and learning more about the culture and things like that. So I'll be off to what they call Caravana next week, and so let's go down to the Q&A in the chat box. Okay. Let's have a look. Who do we have here? Delonda Leon. Hello, Delonda from Baltimore. I hope all is well in Baltimore. And I thank you for being able to join the live stream today. If you got some questions, Delonda, that you think I can help you, please put them in the chat box and I'll get to you. Okay, welcome back, Dr. Joe. I have been to a naming ceremony before, very festive. Okay, Dautu. Yes, it's very, very interesting. And I got the videos and photographs to prove it. And do you enforce your late payment policy every time? Thanks. Yes. Yes and no. Not every time. It depends on the tenant. It depends on the circumstances. So I know there was a time when I first started where I was kind of waiving late fees, and I realized that if there's no penalties, people pay whenever they feel like it. And so I'm at the point now whereby unless there's a unusual circumstance, I'm going to apply a late fee regardless. And I tell the tenants that if they don't pay the rent by midnight the 5th, there's a late fee. And late fees are typically 5%. So if you have a voucher holder, it's not 5% of the total rent. It's 5% of their portion. So if the total rent is $2,000, for example, then the late fee is not 5% of $2,000. Okay. And if the tenant's portion is $1,000, for example, then the late fee will be 5% of 1,000. Okay, which is $50. So so that's what that would be. Okay, so that's what I do. I enforce it. If it's not paid by the midnight the 5th, there's a 5% late fee on the tenant's portion. As you know, I have a lot of Section 8 tenants, and that's worked out quite well. Nobody likes to pay penalties, and we send them lots and lots of reminders, so they know that they've got this amount of days to pay. Otherwise, they're going to be hit with a late charge. And we keep those late charges. We don't waive them unless it's unusual circumstances. So hopefully that was help. Have you ever sold any of your rentals? If so, under what condition have you sold one of your rentals? I have a lot of equity in all my rentals, but I don't see a reason to sell any of them. Well, I agree that too. I have a lot of rentals. I think I've sold 1 or 2 during past 30 something years. I don't usually sell my properties. So under what conditions did I sell those? I sold those properties because they were far. All my properties are within 20 minutes, 30 minutes of my house. These 2 were outliers. They were like 45 minutes to an hour away from my house. And it was just a hassle, dealing with issues when they came up over there. So in the end, I just got sick of it. And, because just, I show my house myself, and to drive an hour to show a house and, just go through that whole ritual, it was just too much of a hassle. So that's the reason why I sold a couple of properties that I had. It's just because of distance. Now, like you, I've got a lot of equity in some of these houses. And so the question becomes, what do you do with that equity? You can tap into that equity through a home equity line of credit, a refinance, or some kind of home equity loan. You can do that, or you can sell. And so I'm at the point now whereby when I have a tenant leave, if there's a turnover, then I reassess, do I want to keep this house or do I want to sell it? If I want to keep the house, then I fix it up and then rent it again. If I want to sell it, then I fix it up and sell it. But at this point, most of the houses, whenever there's a turnover, I tend to just stay in them. I tend to just keep them. I don't sell them. Are any of your rentals in a HOA? 3 of my rentals are in HOAs. The dues have nearly doubled since I bought them, but there doesn't seem to be a justification for the increase in dues. Well, they should have a HOA board, and they should have HOA meetings, and you should be able to attend those meetings, and you should be able to express your concerns and get justification as to, or ask for justification as to why they're increasing these dues. Most of my properties, I don't think I have any. No, I've got one property, which is in a HOA. All my others are not in HOAs, and so I don't have to deal with that. But I know that HOAs, condo fees, they can rack up after a while. But I try to avoid them if I can. Oh my goodness, you got a lot of questions here, Datu. Even though the interest rates are up in my area, there are a lot of institutional investors in my area. Yes, seems that they aren't concerned about cash flow. It's very competitive in my area, low inventory. What area are you in, Datu? You didn't say. But yeah, as I said before, normally when interest rates go up, the market tends to slow down. But we're not really experiencing that this time around. So it's still very, very competitive. And in my area, the DC area, and if it's a good deal, it'll get snapped up real fast. And some of these folks, as you said, they're prepared to pay. And so, they may have some patient money, as I call it. And they may not be so concerned, as you said, about cash flow. And it's competitive. I agree totally with you there. I agree. These interest rates combined with prices do eat up a lot of cash flow. It does. It really does. Okay. It looks like Dow2 is monopolizing this week's Wealth Wednesday Ask Dr. Joe, which is okay. I'm cool with that. So if you got some questions you want to put into the chat box, please put them in. Answer a couple more, then we'll wrap it up. Let's have a look. I asked about a washer and dryer in the chat. You mentioned you don't normally provide them. I have a tenant asking me if I can add a washer to the house. The lease says I only provide the hookups. Well, if the lease says you only provide the hookup, then you're not obligated to provide the actual appliance itself. So you don't have to. Now, you're going to have to make a judgment call whether you should or do a deal with the tenant. Maybe the tenant pays part of it and you pay part of it. I don't normally provide washer dryers because it's just another appliance that can go wrong. And I'd rather not have something that I'm responsible for repairing beyond the stove, the microwave, the dishwasher, and the refrigerator. They're the only appliances I usually provide. The others, I don't. However, if a previous tenant has purchased a washer dryer, like in situation, one of my other ones, the tenant purchased a washer dryer, but for whatever reason, they decided to leave it. And so in that case, I left, I inherited the washer dryer and I offered it to the new tenant. But I told the tenant, hey, this is, I don't normally provide washer dryers. It's here. If you want me to take it away, I'll take it away. If I leave it here, I'm not accepting any responsibility for it. If it goes wrong, then it's on you to fix. But if you want me to take it away, I will. But if you want to keep it and use it, then that's fine with me as well. Okay. Again, put your questions in the Q&A if you got. Should I tell the tenant no? I think you can tell them no, or it depends on the quality of the tenant. You can maybe do a compromise where you pay part of it and they pay part. If they're a good tenants, I usually try to work with my tenants, because good tenants are hard to find. And if it's a shame if the tenant left because you didn't provide them with a washer dryer, which means you're going to have a turnover, and that turnover is going to cost you 1, 2, 3 months lost income, which is more than the price of a washer dryer. So it's sometimes you have to look at the bigger picture and so on. So Dow 2 is in the Phoenix area. Okay. Oh my goodness, probably roasting where you are today for this month anyway. And well, thanks a lot for joining us, Dow 2. I really, you got some really good questions, and you kind of kept me on my toes again. and so on. So anyway, I'm going to wrap it up for today. And 7:40. Hope it was good. Hope it was helpful. Hope it was informative. And we did talk about interest rates, the impacts of interest rates on the real estate portfolio that you may have, and how to navigate that such that you are successful. So with that said and done, my friends, I'm going to wrap it up, and I will see you next Wednesday on Wealth Wednesday. Take care. Bye for now.